Okay, we're live now, Mr. Osborne.
Okay, thank you very much. Could I therefore say to everybody listening in, welcome to today's meeting of the Investment Subcommittee. This meeting is being broadcast live via YouTube, and it's also available for viewing after the meeting. Due to the current situation, this meeting is taking place virtually with members of the subcommittee, along with officers presenting reports joining online. Can I please ask that all members and officers have their microphones on mute until they wish or are invited to speak? And when you're speaking, please make sure the video is turned on. First of all, then, can I ask those present to introduce themselves to those watching online?
I start. My name is Graham, a Melton Borough Councillor, representing the Borough Councils.
I'm Tom Berkeley. I'm County Councillor for Syston Ridgeway.
Sarah Hill, County Councillor, Market Harbour East.
I'm Adam Clark. I'm City Councillor for Ayleston and Deputy City Mayor in the city.
Is Subar with us today?
No, he's not online.
Okay, and is there a staff representative?
Yes, Chair, it's me, Ashley Wilson from Hinckley and Bosworth Borough Council. Thank you.
Okay, good morning. Thank you very much then, Ashley. I don't think there's anybody else. So could I move on to the agenda? The minutes of the meeting held on the 14th of October last year. I propose the minutes of the meeting held on the 14th of October to be taken as read, confirmed and signed. Is everybody content with that?
Content, Chair.
Content.
Okay, thank you. I've received no questions under question time. Agenda item 3, questions asked by members under standing orders. There are none. To advise of any other items which the chairman has decided to take as urgent elsewhere on the agenda. I've not been notified of any urgent items. Declarations of interest in respect of items on the agenda. Does any member have any interest they wish to declare? Not only wish, but should declare.
No, none, thank you, Michelle.
Okay, right. The first item on today's agenda is the Strategic Asset Allocation Update and LGPS Central Climate Fund Transition. They're set out on pages 9 to 16. Declan Keegan, Assistant Director of Strategic Finance and Property, will present this item. So over to you then, Declan.
Thank you, Chair. So the strategic asset allocation paper is just a general update report really on our progress towards the target asset allocation that we agree, or the committee agreed in January. So I was going to, hopefully most of it is kind of fairly familiar, so I was just going to focus really on paragraph 8, the table in there, which kind of just sets out in that beautifully coloured table what we're aiming to sort of get towards. And I'll just go through the different lines. So the first one up there, the private equity. We always have the training slot, and that's on the agenda later, that movement into secondaries, but broadly sort of the private equity is staying where it was with that sort of the approach there. Sorry, I missed the listed. The listed is there's no changes planned in the year. The next one up, the target return fund, is fairly straightforward. It's just waiting for the central product to switch into. But also, again, later on on the paper, Bula shall take you through the multi-asset credit product, and so there'll be a trimming back of that, the current weighting that we've got in there to fund some of that MAP product. In terms of infrastructure and Timberland, we're just waiting for the central product to be launched, hopefully later in this year. But one point to note in there, the Timberland stuff, sort of the ownership of forests and sort of logging operations, etc., that we do, the central aren't launching a product, so it is just going to be a pure infrastructure offer in the future. Properties, similar. Property is actually going to be probably the again waiting for the central product, and probably the asset class will hold on to the longest in terms of having a direct involvement in, rather than be sort of managed through central, just because of the nature and the sort of the fairly horrendous kind of transaction costs involved in property. But the main change we sort of see during this year we're expecting is the a move into a bit more of residential property, and we'll do that with LaSalle, who'll buy into a fund. They're proposing an M&G fund at the moment to just give us a bit of exposure there. So it won't be a direct ownership of residential. It'll be a fund which will give us quite good diversification. And the next area that's going to change is global credit. Touched on this. This is the multi-asset credit product that is later on in the agenda, but a key product for us because we've always struggled a little bit with credit historically, and that kind of things like the private debt, it takes a while to get investments in there, and then they tend to return it to you. Whereas this liquid product gives us exposure to that asset class in a way you can keep exposed without kind of having to make these closed-ended investments. In terms of sort of the next line of private debt, at the moment, again, there is a sort of a small potential in there to maybe make an allocation to distressed debt, which we've done historically, not for quite a few years actually as a fund, but we have done it in the past. We'll get on with to Hyman's later in the year on that one to see whether they do see any opportunities. But it's like I say, it's one we've done in the past, but it may not be an area necessarily this time around. It doesn't seem quite as attractive as it maybe did at one point in time during the sort of the COVID crisis. But again, waiting for central on the main private debt offer, and they are sort of progressing that. It may be an area that we do look at another manager as well, depending on how quickly that sort of central do develop their product, just because we're so far underweight at the moment. And moving into the final sort of like little block of the colourful table, the inflation-linked bonds. Members will remember in February committee there was a decision there to do a sort of a movement from the inflation-linked into a sort of a new investment grade product that Aegon is sort of are offering, which is sort of short-dated investment grade. Just a movement there, and that transaction has completed in the sort of just over the course of the last week. And then the final one, the currency hedge. Again, the paper does touch on this sort of later on. The main movement in there was the just reflecting really sort of the recovery of sterling. Sort of Hyman's advice was to move the sort of the neutral hedge. So, i.e., if Aegon don't have a view on how things are going to be moving, they just sit at the 50%. So to reduce that from 50% to 30%. So effectively, the fund is more exposed to future currency movements. And discussions with Aegon on that would kind of sort of confirm they felt that was probably the right thing to do. But you can see from their approach as well, previously they had increased the hedge on the US dollar, which is the main currency we're exposed to, from the 50% neutral to 60%. But they had, over the course of time, recently reduced that back down to the 50% anyway. So they were heading in that direction. So Aegon's view is actually for the move from 50 to 30, just do it all in one go. So they're going to enact that over the course of the next few weeks. So that'll sort of tick another kind of box in the strategic asset allocation. So in truth, they're the main bits that the paper goes through. The only other piece I was going to pick up that I haven't talked on is down in paragraph 33, the transition to the climate balance fund. Now, this was a movement from our sort of the passive products that we hold with Legal & General, so the ones just tracking an index, move into a central sort of managed product, this climate balance. But it's again, it's still a tracker, but it's just got a bit more sophistication in there, that it kind of there's a few more bells and whistles about how they derive it. So it's probably going to be it's almost certainly going to be our biggest ever biggest transition that we will ever do, and it's £750 million into this fund, and that did take place just before Christmas, and the outcome of the transition was very positive, to be honest. It still costs, as it always costs you money when you move in assets, just a sheer buying and selling cost, and there's always quite a big risk with these transactions as well, because kind of as you can never time things perfectly. As you kind of sell one asset and move into another one, there's always gaps. And you also actually, you can imagine with £750 million, you can actually influence the market as well. So it was a very good outcome. You'll see there kind of the estimated costs in sort of paragraphs 36 and 37 suggested it was going to cost us around 63 basis points, so slightly over 0.5%. But actually, the end result was only 15 basis points, and that 48 basis point saving on such a big transition is pretty big. That's sort of £3.5 million that we saved in less costs. So it reduces the payback period quite significantly on that. And if anybody's wondering why, well, the truth is it's just pure luck. You kind of the transition managers always draw this beautiful bell curve for us, tell us that it's going to be roughly in the middle, but things could go better, things could go worse. They never kind of tie themselves down fully. But this is just an area we got lucky the way that the markets moved. But the good news is the other two equity transitions we did had pretty much fallen in the middle of that bell curve. So on expectations, this one happens that, like I say, we got lucky and kind of a really good result, and we don't have any more equity transitions now in the plan. So overall, we've kind of done better than expected on transitions. So that was a good outcome. So recommendation is just for the committee to note the report, but happy to take any questions.
Are there any questions for Declan? No, then could I thank you very much, Declan. Members are recommended to note the report. Okay, so then if we move on to agenda item 7, the recommended investment into LGPS Central Multi-Asset Credit Fund set out on pages 17 to 20. Members are aware that we'll discuss the contents of the public paper, then go into private session where set out on the agenda to discuss any supplementary information before we're joined by representatives from LGPS Central. We'll then ask them to leave the meeting so we can make a decision on that matter in private. This item will be presented by Bulis, who's the Senior Finance Analyst Investment. He's going to introduce this report.
Thank you, Chair. I hope everybody can hear me okay. So a little bit of background here. This paper is quite brief and we will cover off additional parts in private session. So we'll do a quick background. It goes into the selection of managers. It goes into the managers and mandate overview. And then we've got, like I say, supplementary info in the private session. So a bit of background for MAC, which is multi-asset credit. The fund does have a target allocation of 4%. That equates to around 200 million. And this was set at the January committee, where committee approved a 4% allocation. Central are developing a product, and MAC features heavily within this, and we have engaged with Central in the development of the mandate. We do at present have a small allocation to this area within our current portfolio. We've got about 30 million or 0.5% invested via a JP Morgan Global Credit Fund. A bit of extra background, we also have partnered with 3 other local authorities in developing this mandate. So it's a mandate formed by collective discussion, like many others are. Points 5 and 6 give you a little recap into what multi-asset credit is. I know we've had a bit of training in the background again, but as a quick refresher, multi-asset credit lets managers invest in a really wide universe of products available to them. So it covers things such as cash, fixed and floating, i.e. variable rate credits. They're common. You can go specific to a region or a country. You can be global. We can buy debt in commercial, so that's debt issued by companies, or in sovereign debt, which is issued by countries. So it gives good managers a very wide pool of opportunity to try and get returns in any kind of economic situation. So they also contain exposure to investment grade products, investment grade bonds, and also emerging market debt. You'll be aware that our current portfolio does have exposure specifically to those 2 areas within separate funds. So whilst we were building the mandate, we were keen to make sure we limited the amount of investment grade exposure and emerging market debt exposure that this product would have as well. Overleaf, so on page 18, you'll see that Central's process, when it was concluded, selected 2 managers. So similar to many of the other offerings, it's a multi-manager product. So we've got 2 managers, BMO Global Asset and Western Asset Management. It's important to note that when they started this, they had expressions of interest from over 80 managers, and the selection process noted in points 11 and 12 kind of highlights how it went from that 80 down to the 2 that they eventually had. But the short of it is that they committed to appoint 2 managers in November, and they informed partner funds at that point. A little bit of background on the 2 managers is in points 13 and 14. They're like many of the managers that we've chosen in the past with Central, we've ended up with 2 fairly large managers. Western Asset, circa 350 billion pounds of assets under their management. 800 staff situated across the world. BMO similar, over 100 billion, and covering many continents also. Moving on to page 19, a little bit of a recap regarding the mandate and what we expect to see in there. So the mandate has, you can see a list of bullet points there in points 16 and 17. I've just highlighted on my crib sheet here that we have in point 17, the last 3 bullet points there, we've got limits to single investment, so no single investment more than 5% of the portfolio, and then also no single investments be more than 5% of an issue. So a company can launch a number of bonds. So Volkswagen can issue 10 bonds, but we will never take more than 5% of that single bond from Volkswagen, for example. So it just limits the kind of single issue risk. And the last point on there is the product is hedged, so we have very limited exposure to currency fluctuations. We do have an active hedge, Declan mentioned earlier, that we have via Aegon to hedge other parts of the portfolio that aren't hedged as well. Point 18 covers off what the target for this product is. So this product is targeted to return 4% over cash, and we define cash as the 3-month LIBOR, which is roughly 0 at the minute. So at the minute we're looking at circa 4% return over the time period. We've got some. We don't have actually any past performance records because the mandate is new, so we don't have records from BMO or Western Asset to say this is how they performed in the past. But later on in the private document, we've tried to compile something to give you a view of what we should expect in the long run. Fees are tiered, so the more AUM Central get into this product, the cheaper it should become, albeit the decreases in management fee aren't huge, but we'll talk about that again later. Over onto the last page, page 20. Important to note that there are no performance fees payable to managers for this product. So if they do return the target return or 7% or 8% that we commonly see with other managers, there's no performance fees that come with it. And I think that the summary there is that we've gone to Hyman's, and Hyman's have proposed that an investment to the Central MAP product is the right thing to do. I think that's the end of the paper from me.
Okay, thank you very much, Bullish. There is a comment I'd like to make. It's more of a comment than anything else, and being older and being more familiar with the more simpler ways that the markets used to work. If I look at page 19, you're asking members, and I like to think that I'm fairly savvy as what happens in the financial markets. But when you start talking of derivative instruments, collateralized loan obligations, that starts making me feel very nervous. And I accept that in paragraph 18, you're saying overall higher risk, higher return. I understand that. But if you're asking me to be content with, let's say, the limits on risk management parameters that you've described, I actually would like to know exactly what are these collateralized loan obligations, because they will vary in their quality, and some that you would walk away with very quickly. So I find it very difficult, and maybe other members are more knowledgeable than I, but you know, we're reaching to the point whereby the one thing that we can do and do effectively is merely scrutinise the result. But we can't really, well, I certainly can't feel exactly comfortable in knowing what the risks are when you have got things like derivatives in, collateralized obligations, which I've seen before at much cost to members of the public. Indeed, personally feeling the flames as well. But that's how things go. But I think it's a bit of an ask to ask members to understand completely and sign up to these things.
Yeah, I appreciate the comment, Chair. I think, you know, this mandate was formed with collective discussion, and we were, as officers, talking to Central and trying to trim down the areas of risk, but at the same time maintain the level of return we wanted. And I take your point that it's hard to get a level of return without taking on additional risk. And, you know, collateralized loan obligations have had their fair share of bad press in the past. You know, we've leaned on Central, and we've trimmed those areas down, and we do rely on them to manage the risk at manager level with regular manager interviews. They have a fairly large team at Central now, and I'd hope that, you know, the session we have later on with them, we can dig into these areas more and ask them what their risk management policies are.
Yes, but I don't care how large their team is. As one wag would say, well, Enron had a very large team supporting their company, but it didn't stop them going spectacularly bust. You know, when it was the Leicestershire Pension Fund and we weren't part of the pool, we had presentations made by different companies making a bid for your money. So you could sit there and just ask them, well, please explain to me exactly what the heck's going on. At the moment, and I know I'm outgoing, but I feel it very difficult to get a grasp of what these guys actually are doing. And I hate investing money into things that I don't quite understand.
We got, I think we've got Mr. Barclay and Declan as well. Declan's got something to add.
To join just to add a bit, I think that final point is absolutely sort of spot on. It's a real kind of Warren Buffett sort of quote into only invest what you truly do understand. And I think that you're right, the world's changed a bit where it's kind of, we're now reliant on LGPS Central to put the expertise in the middle to manage those managers. Hence, the reason we get Central along rather than the managers is because the key bit to us is how much faith do we have in what Central are able to do to this? Does Central really understand these products? Would Central kind of rein a manager back who looks to be getting involved in things that they shouldn't get involved in? So that's why we do get sort of Central along rather than the managers directly, because that's the thing that we can kind of directly control. But the thing I suppose I take comfort from, because you're absolutely right, some of these products are quite exotic, and there's, I suppose with anything, there's kind of there's always a spectrum of kind of how risky even within individual products. You know, high yield bonds can vary very much. I think Marks and Spencer's are sort of now sub-investment grade. You know, they're obviously very different to sort of a lot of companies out there. But we're only aiming for 4% above cash, and that should be a very strong steer to the manager that we're not expecting to go, shoot your lights out with the really kind of risky sort of toxic end of the market. That actually these are things that they should just be taking bits of opportunities, they diversify. So the thing I get faith in is the 4%, and that should be what Central are focusing on as well, that they haven't been mandated to do something uber risky. They've been mandated to do a fairly reasonable return, and they've got an opportunity to diversify across the market and take opportunities when they present. But you are right, if Central come across that they don't understand these things, we should be really nervous.
Okay, Tom.
Yeah, I suppose it's really down to LGPS Central selecting the right managers. How do you compare the managers, and how do you make sure that not selecting two managers with similar styles? Because there's not a great deal of it is absolutely, I'm taking what Peter says. We are very much reliant on LGPS Central. We're also highly reliant on the managers that are selected. and I think the mandate is plus 4% over LIBOR or 4%, so it's not hugely risky. But how on what basis were these two managers selected, and how different are they? So give us a balance.
Okay, they went through their standard selection process. So, an external search, they had a selection questionnaire. So, managers had to come back and answer that questionnaire. 45 selection questionnaires were submitted, and they were assessed internally. And then we went back out, or Central went back out with a request for proposal, similar to what they did for corporate bonds and emerging market debt. And they received received answers on 13 categories, and that included, staff turnover, the RRI policy, portfolio turnover, and the decision-making process. It's one that we will pick up again with Central to make sure that we have got two very different managers, so they're not overlapping in the same place. And the due diligence picked up on that also. So I think we and Central are aware that the question you posed is a very important question, that we're not buying the same things across both, and therefore you've got over risked in certain areas.
Yeah.
It's certainly something that we can pick up with the managers or Central when we speak to them later.
I just want one very, very short further one, if I may, Chair. How are you going to monitor these managers? How are you going to monitor their performance? Because you've selected and given them almost carte blanche to do the work. How are you going to actually monitor them over a period of time?
Shall I take that, Chair?
Yeah, please.
So Central have a manager monitoring process. They speak to them on a cycle, and they do this with every manager, be it MAC or equity or any other. So they've got a standard process. They speak to them regularly, and they'll assess them for any changes they've made, how they're performing against the target. Every mandate has a long-term target. They're keen not to move in short bursts. So if you have a 3-year target of being LIBOR plus 4, then you give them 3 years and you react accordingly. A couple of the other mandates we have, they've rebalanced accordingly, where one manager's outperformed and another hasn't. So there's an example of how they're managing these managers going forward. But we're as a group of partner fund officers, we're generally very happy with the way that they speak to their managers regularly, and they've got a big enough team. Hyman's pick up on the size of the teams at Central. Are they able to manage these managers? Have they got the capability? Have they got the experience? So it's all, these are the kind of things that we do pick up as part of due diligence.
No, thank you, Bhulesh.
Thanks, Bhulesh. Has anybody got any questions or comments to give to Bhulesh? Okay, then if we can, thank you very much, Bhulesh. Then we'll move on to agenda item 8, which is the recommended investment Adam Street Partners Global Secondary Fund, set out on pages 21 to 32. As with the previous item, we'll discuss the contents of the public paper. Then, as per the later agenda items, we'll go into private session to discuss any supplementary information before being joined by representatives from Adam Street. We'll then ask them to leave the meeting so that we can make the decision on the matter. So Declan is going to introduce this report on the recommended investment.
Thank you, Chair. So I'll summarise the paper quite heavily. Obviously, we've had the training with sort of Adam Street, and they're coming back later to talk through it. But the secondaries, as you know, is an area we've invested in before, and it's just worth bearing in mind that Adam Street Partners is a fund of fund manager, so they're not necessarily going and picking individual kind of companies to invest in, but they're picking a manager in some way to sort of how Central does it. They're picking that manager who then goes and has these investments in companies. So it is very much that kind of, I suppose, one step removed, and there still is a sort of a degree of diversification in there. Obviously, the natural question on any investment we make is, why aren't we using LGPS Central in line with pooling? And the truth of this one is, it's secondaries isn't something that every pension fund does do, and there wasn't sufficient interest across the sort of the other partners for sort of a secondary sleeve in in the central product for 2021. Now that may change in the future, but at the moment our choice is either to kind of just have a sort of a primary investment or to kind of carry on with sort of secondaries with Adam Street Partners. And Hyman's view in terms of sort of assessing the opportunities out there is actually now's a good time to sort of dip a bit more into sort of secondaries. We've already got some exposure, but to just up that a little bit now. And it's, in the scheme of things, it's not a very big investment, but it's sort of viewed as the best approach for the sort of Leicestershire fund. It's sort of another sort of slightly funny one on this one is if you look at sort of the weighting at the moment, we're actually overweight to private equity, which then begs the question, well, why on earth are you proposing to put more money in there? But the table in paragraph 11 does sort of set it out quite nicely, and this is all to do with this a closed-ended product. So Adam Street are forever sort of throwing money back at us as investments mature. They sell out of kind of or underlying companies get sold, money comes back to us. So we're always having to top it up to make sure we're kind of there and thereabouts on the weight. And you'll see kind of over the next couple of years, if we don't invest, we're going to start to drop quite sort of heavily below the target weighting. So it's just getting in ahead, and it does take a little bit of time to get the money away as well. If I draw your attention to sort of paragraph 17, it's quite a nice sort of summary of kind of why you'd go into secondaries, and you can sort of summarise it in some ways. If kind of, partly it helps with sort of the risk profile on this. You know exactly what you're going to buy into. Normally, when we invest in private equity, all you're doing is you're backing the managers to go out and find some companies, where with secondaries, Adam Street can actually go in and see those underlying investments. So it helps on that side. And also, as Adam Street sort of pointed out a few times, it's a shorter duration. You're actually going in with the money. It's a known kind of purchase, as opposed to actually waiting for these companies to be fine investment. So that can help with the risk. You can still have quite a risky investment in secondaries because, depending on the underlying companies bought, but at least you know what you're getting into. And then the third kind of the third area, and it gets stressed quite a lot, is the discounts to the underlying asset value. And I would kind of urge a bit of caution on here that we should sort of probably see the discount as a bonus as opposed to the raison d'etre for kind of doing it, because obviously there's a discount for a reason. Someone wanting to get out and sell something, and we're buying it. So, and these product and the sort of the unlisted sort of companies are notoriously difficult to value. So I would sort of stress, although the discounts can sound quite alluring, we need to just sort of make sure we're kind of happy with sort of the underlying purchase, because effectively that's what you're getting. Like I say, these products are difficult to value. And we can obviously get into it a bit more in the private session, but just as a sort of a final word on the sort of central product, the paper does finish off on that, and it is progressing well. They did appoint a new director on sort of the private markets, and they're hoping to sort of have something that we can then come back to sort of the investment subcommittee before the summer to approve, hopefully. So happy to take any questions, or happy to get equally to wait for the private session.
Any questions? I can't see anybody doing. Got to thank you very much then, Declan. Moving on to agenda item 9. The date of the next meeting is the 28th of July 2021 at the usual time of 10 o'clock. So for those who are looking to get re-elected, the best wishes for that. We'll then move on to the exclusion of the press and public. The public are likely to be excluded during the consideration of the remaining items in accordance with section 100A(4) of the Local Government Act 1972, exempt information. So I just wait for confirmation that the live stream has ended. But could I thank anybody who has been watching or will watch it later? Thank you very much for your interest.